All right, welcome to The Explainer. Today, we are diving headfirst into the 2026 housing market. And wow, is it a weird one. It's packed with so many mixed signals that everyone is asking the exact same thing.
Is the housing market finally about to crash, or are we looking at a big rebound? Honestly, if you're confused by the headlines, you are definitely not alone. One minute, you hear prices are going up. The next, they're on the verge of collapse. So, what is actually happening out there?
I mean, just take a look at this. The forecasts are all over the map. You've got Goldman Sachs on one end, super bullish, predicting almost a 5% jump. On the other end, you've got BiggerPockets saying, nope, prices are going to dip a little. And then smack in the middle, JP Morgan is calling for, well, basically nothing, a flat line. This isn't a crash, and it's not a boom. It's a full-blown market standoff.
So, to figure this all out, here's how we're going to break it down. We'll go through the big standoff, what's up with mortgage rates, this new wild card at the Fed, the two-faced market, new rules from DC, and finally, what all this means for you. Let's get into it. All right, first up, the great 2026 standoff. The big question here is, why isn't this another 2008? It's a totally different beast, and we need to understand why.
Okay, so here's the absolute key difference between now and 2008. Homeowners today are sitting on a mountain of equity. We're talking record high levels. That means no panic selling, no wave of foreclosures like we saw back then. People aren't underwater on their loans, so they're not being forced to sell. That single fact changes the entire game.
Okay, let's move on to the elephant in the room for pretty much any buyer, mortgage rates. We have to face it, the dream of 3% rates is over. It was fun while it lasted, but we're living in a totally new normal now.
Yep, pretty much every major forecast, from the Mortgage Bankers Association, NAR, Wells Fargo, you name it, they're all pointing to one number, around 6%. That seems to be the new floor. I think we're all starting to realize those crazy low pandemic rates were a once-in-a-lifetime thing, not the rule.
And the Federal Reserve basically confirmed this. In January, they hit the pause button on rate cuts. So what does that tell us? It means the painful rate hikes are probably done. Thank goodness. But don't expect a quick drop back down to those super low numbers either. They're just waiting and watching.
Now, this is where things could get really interesting. There's a potential shakeup coming at the Federal Reserve. President Trump's nominee to take over, a guy named Kevin Warsh, has some, let's say, unconventional ideas that could completely flip the script.
So to get what Warsh might do, you need to understand this one thing: mortgage-backed securities, or MBS. Think of them as big bundles of home loans. During the pandemic, the Fed bought trillions of dollars worth of these things. Why? To push mortgage rates down to those rock-bottom levels we all remember.
And this slide lays out the huge difference in strategy. Powell basically held on to all those MBS to keep things stable. Warsh, he wants to do the exact opposite. He wants to aggressively sell off the Fed's $2 trillion portfolio. Now here's the crazy part. Even though the goal might be lower rates down the road, dumping all those bonds on the market at once could actually cause mortgage rates to spike in the short term. It's a really high-stakes gamble. Okay, so this is probably one of the most important takeaways from this whole explainer. You can't just look at the national numbers anymore. Real estate in 2026 is a tale of two completely different markets. It's all about location, location, location. On one hand, you have places like Hartford, Connecticut. Zillow just crowned it the #1 hottest market for 2026. And it's no joke. Housing inventory there is down a mind-blowing 63% from before the pandemic. That means bidding wars are still happening and 2/3 of homes are selling for over the asking price. It is still an absolute feeding frenzy in some of these Northeast and Midwest cities. But then you've got the other side of the coin. Those Sunbelt boomtowns, think Austin, Miami, Tampa, are finally cooling off. Inventory is actually starting to pile up. A place like Indianapolis is now considered the best market for buyers. You have more options, more power to negotiate, and home builders in the South and West are tripping over themselves to offer incentives like rate buydowns.
And if all that wasn't enough, we've got new rules coming out of Washington that are trying to shape things up, specifically to tackle the affordability problem.
So, there are two big policy proposals to watch. First is a ban on institutional investors, basically trying to stop Wall Street firms from buying up single-family homes with federal financing. And second is the Home Savings Act, which would let you pull money from your 401k for a down payment without getting hit with a penalty. And what's really interesting is that President Trump himself seems a little lukewarm on that 401k idea. He basically said, 401ks are doing much better than the housing market. And he kind of has a point, right? It raises the question, does it make sense to take money out of a growing retirement account to put it into a housing market that's just stuck?
Okay, we've thrown a ton of information at you. So what does this all mean for you? Let's boil it all down into a simple playbook, whether you're looking to buy, sell, or just stay put.
All right. If you're a buyer, your strategy for 2026 is all about being surgical. Target those buyer-friendly cities we talked about, like Indianapolis. Definitely look at new construction. Builders are desperate to make deals. And most importantly, please stop trying to time the market. If you find a home you love and can actually afford for the long term, waiting for rates to drop is a huge gamble. Because if they do, prices are just going to shoot right back up. Now, for sellers. Your game plan is simple, but it's crucial. You have to know your local market's temperature. If you're in a hot spot like Hartford, you're still in the driver's seat. But if you're in a market that's cooling off, you've got to price your home realistically. The days of the 2022 feeding frenzy are over. And look, for a lot of you, the absolute smartest move right now might be to do nothing. Just sit tight. If you have a mortgage rate at 3 or 4%, that is like gold. Giving that up to jump to a 6% rate is a massive financial hit. And if you're renting, with rent barely going up, 2026 is the perfect year to just save, and build that down payment. So that leaves us with the big final question. This great stagnation we're in, is it a bridge to a more stable, normal market? Or is this calm window with 6% rates just the eye of the storm before a new wave of volatility hits in 2027? We're in a transition, and what comes next is anybody's guess.